Okay, good morning, guys. Let me just, it's always this pop-up. I don't know if everyone else gets this, but whenever you log into Zoom, this pop-up comes up. It's kind of annoying. Um, okay, well, welcome. Today we're going to be taking a deep dive into the financing commitment contingency and the appraisal contingency. So, just taking these two sections and highlighting each and then discussing how they work in conjunction with one another. So, um, as always, stop me at any time with questions or comments. I don't expect this to take the whole hour, but we can open it up for just general questions after that. So, all right, so let's get going. Um, So the financing contingency is lines 247 to 287 of the offer to purchase. I just highlighted the WB11 lines. These are different in the condo offer to purchase, but it all reads the exact same way. So the main sections of the financing contingency are the terms of the loan, so mapping out those terms, the satisfaction of the contingency and how that provision reads, seller's termination rights, and what happens when financing is unavailable and how we handle that. So first up, again, so starting at lines 248, we've got the financing commitment contingency. So if you are going to be including a financing contingency, then you're going to mark the box with an X. If you're not, remember we always like to encourage that you are saying NA whenever you are not including a contingency. And that's just to demonstrate that you have gone over it and you are being intentional about not including it versus just leaving it blank. So the way that it reads, so this offer is contingent upon the buyer being able to obtain a written, and then you're gonna here in this blank line, specify a lender or the loan type. So 9 times out of 10, you're just identifying the loan type. So I've included all of the most common here, but you're just going to be choosing one of these. So either a conventional loan or an FHA loan or a VA loan. It could be a jumbo loan. So you're just going to pick the loan type that your buyer has intentions of using and then name it here. So this offer is contingent upon a buyer being able to obtain a written conventional first mortgage loan commitment as described below within blank days after acceptance of this offer. So this is where you are identifying the deadline and how long it's going to take for this buyer to obtain financing, get it through underwriting, and then for the lender to issue a loan commitment letter. So I put in here that 25 to 30 days is pretty typical. So you're not writing out this range, you're just, you're picking a solid number. So 25 days or 26 days, 27 days or 30 days, etc. So I would say what is typical is I would say 25 or 30 days. And this is where too, I'd like to speak to strategies for writing in competition. So, the sooner that you can waive this contingency, the sooner that you can waive any contingency for a buyer is going to be more preferable to the seller, right? So I work with a lender who is able to get the financing contingency or get loan commitment, excuse me, in like 21 days. So, and I purposefully use that lender because of that fact. If we want to make sure that we are getting this financing contingency waived as soon as possible, I want to try and find a lender who can do it really fast. So just kind of keep that in mind. But I would say it typically does not take more than 30 days for a loan commitment letter to be delivered. Um, Okay, so moving on, the financing selected shall be in an amount of not less than blank for a term of not less than blank years, amortized over not less than blank years. So on line 251 here in this first space, you're going to put in the actual loan amount. So let's say this purchase price was 200,000 and the buyer has intentions of putting 20% down, then that would make that loan amount 160,000. So you're not putting the purchase price in there, you are putting the actual loan amount there. And then moving on, then you're spelling out the amortization schedule. So is it a 15-year loan? Is it a 30-year loan? Is it a 10-year loan? 9 times out of 10, your buyer will be obtaining a 30-year financing. So then it would be 30 years and 30 years. Again, though, if it was a 15-year mortgage, it would be 15 here, 15 here. Um, Initial monthly payments of principal and interest shall not exceed blank. So depending on the loan amount, how long it's amortized over, and down here on line 264, the interest rate, you're going to plug these numbers, the loan amount, how many years, and the fixed rate. You're going to plug that into your loan calculator and you're going to come up with this number. I do have to comment real quick. I did this last training in 2022, and you can tell by the interest rate that I have 3.5 down there. And they're like 6.5 right now, probably more than that. So I just had to laugh at that. So Carl's mortgage calculator is the one that I use. You can just download an app on your phone. But obviously you're not expected to know how to do that math. It's a complicated, it's not easy math. So you have to download a mortgage calculator and that will give you, again, based off the loan amount for over how many years and the fixed rate, that will give you what the monthly payments of principal and interest shall be. Okay. Now a note here. So the next statement spells this out. So this is just the amount for principal and interest only. So moving on, the buyer acknowledges that the lender's required monthly payments may also include 1/12 of the estimated net annual real estate taxes, hazard insurance premiums, and private mortgage insurance premiums. So, the buyer needs to have an understanding. This is not their monthly payment. If they are escrowing for taxes, if they're escrowing for insurance, and then depending on how much they're putting down, they might have PMI, which is that private mortgage insurance. So their total monthly payment is likely going to be, not likely, it will be higher. So this number, assuming that a lender, excuse me, assuming that the buyer never refinances, this number is fixed over time. And monthly mortgage payments can fluctuate depending on taxes and insurance. So, insurance taxes are typically going up year over year, as well as insurance. So this monthly mortgage payment may increase over time. So the mortgage, so continuing on line 254, the mortgage shall not include a prepayment premium. So this is just saying that there is no penalty if the buyer prepays off their loan. Buyer agrees to pay discount points in an amount not to exceed blank of the loan. So if the buyer does intend to pay down their rates, you can put in points there. I have never actually used this line. If the buyer intends to pay down their mortgage or pay down the rate, excuse me, that's usually just being worked out between the lender and the buyer. So if the buyer is using multiple loan sources or obtaining a construction loan or land contract financing, describe those at 543 to 551 or in an attached addendum. So if, let's say, yes, exactly as it says, if your buyer intends to go to multiple sources and they want to make sure that the offer is contingent upon them obtaining all of the the intentional loans that all of the loans that they intend on getting, then we need to describe that other loan type in the additional provisions. And then likewise with land contracts, um, if a land contract is involved, we are not drafting those land contracts, but our role in that is to describe it and attach it to the offer to purchase. So we're not going to get into land contracts, but if you guys ever do have a buyer who wishes to do a land contract, it's not often, but we can help navigate that for you in terms of guiding you on how to put it into the additional provisions. But the land contract itself, again, an attorney would be drafting that. So just come to us if you guys have questions on that or run across it. All right. So then 257 to 259. So this is a good reminder for buyers. So buyers agree to pay all customary loan and closing costs, wire fees, and loan origination fees, to promptly apply for a mortgage and to provide evidence of application promptly upon request of the seller. The seller agrees, and then this is a provision for the seller agrees to allow lender's appraiser access to the property. So this is a good checkpoint for you as a buyer's agent, just to remind your buyers, beyond your down payment, you do have closing costs. And, typically you're covering this kind of thing in your buyer consultation, when you're going over expected fees for a buyer and expected costs for a buyer. You're going to be hitting that at the uh, buyer consultation. But then I think here is a nice checkpoint for you to re-remind the buyer again of closing costs, of wire fees, etc. And then for our sellers, when we are presenting these offers as listing agents, we're reminding them, if we're accepting an offer with a financing contingency, we're agreeing to allow that appraiser into the property. And there have been issues with stuff like that, so that's why it's in the offer. All right, line 260, so loan amount adjustment. So this is a nice provision because if the purchase price changes during negotiations of the offer, you don't have to rewrite the loan amount or the principal and interest monthly payment amount. So if the purchase price under this offer is modified, any financed amount, unless otherwise provided, shall be adjusted to the same percentage of the purchase price as in this contingency, and the monthly payments shall be adjusted as necessary to maintain the term of the amortization stated above. So again, when you're countering back and forth, you just have to counter price back and forth. You do not have to rewrite these numbers out. Okay. Then line 263, 264, and 265. So this is where you're identifying whether it's an adjustable rate mortgage or a fixed rate. And again, 9 times out of 10, that buyer is going to be obtaining a fixed rate conventional loan, and you're going to identify that rate in line 264. So a good rule of thumb, if rates today are at 6%, we're going to be padding that number by 1/4% in the event that the rates were to jump by the time that they locked in. So a good reminder for a buyer then at this point, and we get this question, a buyer will push back and say, hey, wait a minute, my lender told me that I'll likely lock in at 6%. And in here you've got 6.25. So the communication to the seller is in the event they get up to 6.25, that buyer is willing to move forward. But if they jump higher than that, then they could walk away because it jumped higher than they had expected or had planned on. And then, Mr. Buyer, you can lock in lower, but you're just saying to the seller, if they do get up to that point, you're willing to move forward. So again, what you're identifying here on 264 is likely not what they're going to end up locking in at. But if you think about it, it's nice because let's say, they end up jumping to 6.5%. I mean, that drastically changes what a buyer was planning on um, in terms of their monthly payment, and they might not be comfortable moving forward. So then the adjustable rate financing, if your buyer ends up doing an ARM, this spells out the parameters for the ARM, and I'll have you just, you're going to consult with the lender on what to put in there. So, any questions so far? Right. Okay, so the next section gets into the satisfaction of the financing commitment contingency, seller termination rights, and financing unavailability. So, um, assuming that the buyer qualifies for the loan, then it spells out how we satisfy that contingency starting at line 270. So if the buyer qualifies for the loan described in this offer or another loan acceptable to the buyer agrees to deliver to seller a copy of a written loan commitment. This contingency shall be satisfied if, after the buyer's review, the buyer delivers to the seller a copy of the loan commitment, even if it's subject to conditions, and it needs to be either signed by the buyer or accompanied by a written direction for delivery. So it used to be the case that we needed a separate permission to deliver document signed by the buyer, and then we would accompany that along with a loan commitment and deliver that to the listing agent, and that would satisfy the loan commitment contingency. Now we are able just to take that loan commitment letter and we can add signature boxes to the loan commitment letter wherever, and that also is acceptable, and we can just send that on to the listing agent. So, line 276, so the delivery of a loan commitment by the buyer's lender or delivery accompanied by a notice of unacceptability shall not satisfy this contingency. So, what it's stating here is, the buyer's lender is the one who's actually issuing this loan commitment letter. If that buyer's lender sends it off to the listing agent, and it doesn't pass through us first, that doesn't count. It has to pass through us first and be delivered via the delivery lines, the delivery methods that is spelled out in the offer to purchase. So, and then of course, if the buyer does not qualify for the loan, then obviously that's not going to satisfy the contingency. And then here's a big caution line for the buyer, and this is something that we need to be paying attention to. So the delivered loan commitment may contain conditions that the buyer must yet satisfy to obligate the lender to provide the loan. So the buyer understands that delivery of the loan commitment removes the financing commitment contingency from the offer and shifts the risk to the buyer if the loan is not funded. So, if it's conditioned upon, I can't even think of like the buyer still needs to provide some paperwork to the lender. And we have delivered a loan commitment letter that states, buyer does qualify for this, but they still have yet to deliver this paperwork to us. And if they fail to do so, then we cannot close, right? So if that buyer ends up sending this letter, even though those conditions were named and they don't meet those conditions, then all of that risk does go to the buyer. So it really is very important that we're reviewing these loan commitment letters to make sure that there's nothing that a buyer could potentially not satisfy. So, typically we're having, there's just like administrative details that a lender still needs to get done. And, typically it's safe to still deliver that loan commitment letter with those kind of administrative conditions on it. But if there's something big, I would be going back to the lender and saying, hey, wait a minute, you know, is this something that we should be concerned about? So instead of delivering this loan commitment, should we be extending the financing contingency, for example? So, and lenders know, I mean, their job is to remove as many conditions before issuing a loan commitment letter. But if anything looks weird to you, go ahead and question the lender, and just confirm. So, um, because again, we could be putting our buyers in a tough position if there's something on there that like they don't somehow meet and we didn't question it. So,
Yeah, one of the toughest ones is the buyer decides in order to get a competitive offer in, he doesn't put in a house sale, closing contingency. And he
mm,
thinks he has a pretty good shot at getting his house sold. So he gets a loan commitment from the lender that says you're approved for the loan if you have the proceeds when you sell your house. And he can't deliver that because he didn't put in a house sale contingency. So he's removing his financing commitment contingency and his house doesn't sell. He still
mhm,
has to come up with that purchase price for that new house. He's still obligated to go to closing with the money.
yeah,
That's one of the most extreme situations, but we've seen it. We get calls on it. Now what?
right. Yeah, it's more just like being vigilant about reviewing these loan commitment letters. And it usually is like a nice, it's sectioned off like conditions still to be met. So, it's pretty easy for us as buyers agents to like zero in on it and find that section. So, okay, so seller termination rights. So, we get this question a lot. So, I'll read it first and then go over it. So, if a buyer does not deliver a loan commitment on or before the deadline on line 250, seller may terminate this offer if the seller delivers a written notice of termination to the buyer prior to seller's actual receipt of the written loan commitment from the buyer. So, let's say today is a deadline for a financing contingency that I have at an offer, and we don't end up extending the loan commitment deadline. Um, it does not mean that the offer is dead. All it means is that it opens up these seller termination rights. So, today is the deadline. We don't uh, extend it. So the deadline remained for today, and then tomorrow comes. So again, we can just proceed as normal. But now the buyer is in a tough spot because until we deliver that loan commitment letter, the seller could, if they chose to, terminate the offer at any time. So we've got day 31, and I haven't delivered loan commitment yet. Seller has not terminated the offer. Then we just go on to day 32. Day 32 comes and goes, and buyer still has not been able to deliver loan commitment. Seller is, they're in a position, you know what, that's fine. We'll just hang out until we receive it. We don't have any other offers. We're okay. Day 33 comes and maybe seller is, getting antsy and they're like, well, we just want to move on now because we still have not received this loan commitment. They could, if they wanted, declare the offer null and void because they have not received that loan commitment letter. On the flip side, the buyer on day 33 could deliver that loan commitment letter, and now the seller's termination rights are gone. So it's kind of interesting how that works. As a listing agent, you might be questioning whether or not you want to extend a financing commitment contingency deadline. And that might be the strategy that, as a listing agent, you might need to take. Typically, though, if there is an issue with getting something satisfied, a buyer's agent is going to go to that listing agent and say, hey, buyer still needs to do X, Y, and Z. Can we extend this loan commitment contingency? And buyer and seller agree to extend it, and then you're going to give a few more days. Ideally, that's what's happening. Um, but again, it's once a deadline comes and goes, then it does not mean that the deal is dead. And it also does not mean that the buyer is not able to deliver a rejection letter. So that's the next section. So if the buyer does not uh, qualify for the loan, and even though it's past the deadline, they still have the ability to deliver that rejection letter. Um, so that's again the next section starting at 284. So if a financing commitment is not available on the terms stated in this offer, and the buyer has not already delivered an acceptable loan commitment for other financing to the seller, the buyer shall promptly deliver written notice to seller of same, including copies of lender's rejection letters or other evidence of unavailability. So there's a few things in here. If the financing commitment is not available on the terms stated in this offer, so you know, up on line 271, it states, if a buyer qualifies for the loan described in this offer or another loan acceptable to the buyer agrees to deliver loan commitment. So we get this question a lot where a buyer wants to switch the loan type midway through. And depending on, what they're going from and to, a buyer is able to do another loan type. What the buyer cannot do, though, is let's say they switch from conventional to FHA financing. And the conventional loan is what the buyer, or sorry, excuse me, the conventional loan is what the seller had agreed to when they accepted the offer. If the buyer doesn't get that FHA loan, then they have to go back to that conventional loan because that's what they had spelled out to the seller in that offer to purchase. So they cannot serve a rejection letter based off of an FHA loan type because that's not what they had spelled out in the terms stated above. So they either need to go back to attempting a conventional loan, and then at that point, if they're not able to get the conventional loan, then they can serve a rejection letter. We had a question over the weekend actually where a seller accepted an offer on a VA, or I'm sorry, on a conventional loan. Buyer decided midway through they wanted to do a VA loan, which was fine. But if that buyer was not able to get the VA loan, um, then they would have to go back to that conventional loan, even though a VA loan is probably better for them. So that's why we spell out those terms above, but it doesn't mean that a buyer couldn't try and get a different loan type. So, um, okay, so then the buyer shall promptly deliver written notice to the seller, including the copies of the lender's rejection letters or other evidence of unavailability. So if the buyer is not able to obtain financing, we're going to spell that out in a notice, and then we've got to prove that to the seller, and the lender should be issuing a rejection letter stating that the buyer is not able to obtain financing, and then we're going to pass that along to the listing agent and the seller. Any questions?
Yeah, that was well explained, Steph. This probably is the most complicated area where we do get a lot of questions. And there's a lot of strategy in this. So make sure you as a buyer's agent and you as a seller's agent, a listing agent, understand these rights that the seller has and that the buyer has.
Mhm.
It's pretty twisty in there.
Yeah. Yeah, back to the seller termination rights, we've had a lot of like shaky or like, buyers just kind of being, I don't know, questionable practices, or maybe like the communication hasn't been clear along the way. And, you know, it comes down to the buyer wanting to extend loan commitment. It might be in the seller's best interest to do so and leave it open for them to be able to get out of the deal easier.
Right.
So, okay. So the appraisal contingency is next. And this is lines 308 to 326 of the offer to purchase. Between the financing contingency And the appraisal contingency, there are more provisions around like cash offers, which we're not going to go through today, but just to let you know, obviously it is the case where a buyer could pay for cash, and then we're skipping the appraisal, sorry, we're skipping the financing contingency altogether. So, okay, so we've got the appraisal contingency, and then the concept of right to cure is attached to an appraisal contingency, just like it's attached to an inspection contingency. So we'll go over that. Okay, so starting at line 308, we've got this offer is contingent upon the buyer or the buyer's lender having the property appraised at buyer's expense by a licensed or certified independent appraiser who issues an appraisal report dated after the date on line 1 of the offer, indicating an appraised value for the property equal to or greater than the agreed upon purchase price. So I'm going to go back to either the buyer or the buyer's lender obtaining or having the property appraised. So it might be the case if there's a cash offer, a buyer might choose to independently order an appraisal for themselves, because even though they're paying cash, they may still want to protect themselves and make sure that they're not spending more money than an appraiser might think it's worth. So I just do want to point that out, because it is, you know, 9 times out of 10, an appraisal is associated with that lender ordering it, and with the interest of the lender making sure that they're protecting themselves and making sure they're not, you know, loaning more money than the home is worth. But a individual could be ordering an appraisal themselves. So um, then the next piece in here is that it's a Wisconsin licensed or certified independent appraiser. So, you know, there is you know, appraisers are doing their own education, their own continuing education. They do need to be licensed. So, and it's got to be Wisconsin licensed. So just like an inspector, um, you know, we can't pull in somebody from Illinois or something. It's got to be a Wisconsin licensed appraiser. And then the appraisal report has to indicate a value of the property, of the purchase price, or greater. So, and then if it's not, that's when we'll get into the right to cure. So, we're putting a deadline on this as well. So the contingency shall be deemed satisfied unless the buyer within, you know, either 25 days, 30 days. Um, I feel like with the appraisal contingency, you can make this a little bit less. Oftentimes, I know personally I'm putting 15 days in after acceptance. Delivers the seller a copy of the appraisal report indicating an appraised value less than the agreed upon purchase price and a written notice objecting to the appraised value. So this is where the right to cure comes in. So, you know, ideally, you're getting an appraisal. It's appraising at the purchase price or higher, and buyer's agent is letting the um, listing agent know, hey, it's appraised, and then everybody is moving on their merry way. If it comes in less than the purchase price, that's where some options open up. So just like an inspection contingency, a a buyer could attempt to negotiate with this seller and say, you know, I my offer was for 200,000, but it came in at 190. Are you willing to come down to 190? Are you willing to meet in the middle? You know, that number can be negotiated. Um, and if it's not, if the seller is just refusing to come down, that's when now the buyer can make a final line in the sand, draw a final line in the sand and say, okay, I attempted to negotiate the price with you, but you're choosing not to. So now I'm going to serve a notice of my objection to the appraised value. And because we have the right to cure in here, depending on if we've given the seller the right to cure or not, the deal may be dead. So just like within the inspection contingency, if we did not give that seller the right to cure, if the buyer serves a notice objecting to the appraised value, then the deal is dead right there. 9 times out of 10, though, we're giving the right to cure in, sorry, 9 times out of 10, the buyer is choosing to give the seller the right to cure. Um, and so now that same notice, that buyer serves the notice, I object to the appraised value, and now the ball is in the seller's court to determine, okay, before they were making requests of me to come down on the purchase price, and now they're just saying you have to come down to the purchase price or let me out. So if you think about how the inspection contingency works, it works the same way. So, we're negotiating at first and there are failed negotiations and now it's a hard line in the sand. Okay, I was asking now, I was asking before, but now I'm saying you have to, or just let me out of the deal. So, typically right to cure, and like it's usually just not even getting to this point. Typically, typically buyer and seller are coming to an agreement on price. Um, but what I want you guys mostly to hear is that it just works, the concept works the same way as it is attached to the inspection contingency. So, um, again, the way that it's the roadmap is the same. So the offer shall be null and void if the buyer makes timely delivery of the notice objecting to the appraised value and the written appraisal report, and the seller does not have right to cure. So again, if the seller does not have right to cure, notice is delivered, then the offer is null and void. Or if the seller does have the right to cure, the seller delivers the written notice to the seller that they will not adjust the purchase price, so then it's null and void there. Or if the seller does not timely deliver the written notice adjusting the purchase price within those days marked on line 317, then just by the passage of time, because the seller was just sitting on it, then that means that the offer is null and void as well. If that seller now chooses to cure, quote unquote, and delivers a notice back saying, we will come down to the appraised value, then everyone stays in the deal and then we're going to move forward to closing. Okay. In practice, so the appraisal contingency is tied with the financing contingency in that it's the lender who is protecting their interests by ordering that appraisal. So, it's a part of the lender's underwriting processes to have an appraisal done. So that's why they work hand in hand with one another. Again, in practice, the buyer's lender is the one who is ordering that appraisal. So as buyer's agents, we're hands off with that. Our role in that is to make sure that we're meeting deadlines. And, so if we're coming up on a deadline, we're checking in with the lender to say, hey, is this back yet? A good rule of thumb is after you guys are through inspection, is to make sure, okay, we're through inspection, let's go to the lender now and make sure that they have ordered that appraisal. So you're just kind of working with the lender to make sure that they're doing their job essentially, and just like, just checking in on behalf of your buyer, like, hey, did we get this done? So that's where our role is as buyer's agents. Switching loan types midway through transaction, we kind of touched on that already. So, it is acceptable for a buyer to do that. Um, but there are, potential consequences in that, if it's something that a seller, um, there's consequences for the seller depending on the loan type. Then that's where I would be weary for a buyer. Again, FHA loan is a big example of that. So let's say a seller accepted an offer with a conventional loan and the buyer decides to do an FHA loan, which fine, but if anything comes up on that FHA appraisal process, and again with FHA loans, there is a extra kind of checklist that appraisers have to work through, looking at like safety items and more physical items, like physical elements about the property that a FHA appraiser has to look through. So like handrails, peeling paint, etc. So let's say that FHA appraiser comes back to that buyer and says X, Y, and Z has to be done in order for us to give you this loan. It's going to be a real tough sell to go back to a seller and say, hey, this has to be done because of this FHA loan. And the seller is like, wait a minute, we didn't accept an FHA loan. We accepted a conventional loan. So either you got to get that figured out or you got to go back to a conventional loan. So you just kind of have to be mindful of that. Appraisal language in competitive markets. So, on our addendum ACs, which is a completely separate training, but we've got language for padding that appraisal or giving a gap, and excuse me, if there is a gap between the appraised value and the purchase price value. So, a buyer may communicate to a seller, okay, I'm going this much over asking, but I'm telling you that if it does appraise lower, I'll cover $5,000 of it, for example. So we're not going to get into that too much because, again, it's a separate training, but that is a tool that you can use in a competitive market. And then, yeah, appraisal process for the FHA and VA loan. So circling back up to what I was just referring to earlier, FHA and VA loans have an extra set of guidelines that the appraisers have to adhere to in terms of the condition of a property and things that they need to be looking out for that will be required to be remedied prior to a closing. So again, it's like safety items, missing handrails, peeling paint. Um, so again, those could be conditions that a buyer needs to make sure are handled or addressed in some way in order for them to obtain a loan. So, um, and I was speaking to the fact that, like, let's say a buyer switched to an FHA loan, but let's say there was a seller who accepted a loan with an FHA, for an FHA buyer, that seller is communicating to the buyer in some way, you know, I will work with you. I will potentially work with you on anything that comes up on an FHA appraisal. And a good listing agent is going to be making sure that a seller is aware of what that means when they are accepting an offer with an FHA loan. Um,
Steph, I want to ask a question to you that comes up. Um, I actually learned last year for the first time that they didn't have to send an amendment to switch from conventional to VA or FHA in mid-transaction. That if the buyer wanted to switch from a conventional to an FHA, he just did. I always thought he had to send an amendment and get the agreement of the seller to switch, because there is a difference.
yes. I think the agreement has to be with that FHA or VA addendum that is provided. So,
That's
that's where, and that was kind of the question you probably weren't looking because you were out of town, but you were CC'd on an email to us from an agent who had they were on the listing side and they were presented with that VA addendum.
I
And
did,
yeah, so
and the seller wasn't going to sign
that they didn't want to sign it. And no, I
it.
mean, I think that, you know, just perfectly within the seller's rights not to want to sign that. And we just had to make them comfortable with, okay, we're already through appraisal, so, we should feel comfortable moving forward. And you would be doing the buyer a favor in a sense by accepting this and signing this.
Yes,
But yeah, you're right. I mean, we don't have to amend it, but like I think that's where then the agreement comes
yeah,
from, just within the acceptance of that VA addendum or that FHA addendum. So, um,
thank you.
yeah, because I thought the same thing too.
Mhm.
Any questions, you guys? Okay. Next week, and this will probably be a shorter training, I imagine, but next week we're going to be going over writing as a principal in a transaction. So, and we could probably also then cover when we'll touch on this when we're selling our own property and the types of things that we need to make sure we're including in the offers. Um, so stay tuned. But then we'll probably open it up for Q&A, I imagine. I don't think it'll take too long.
Right. Are you doing that or am I doing that?
I don't know. I think we to be determined.
Okay. I thought I was doing that. So,
Yeah, you can take that on.
okay.
Okay,
Good.
guys. Thank you. All right, we'll talk to you soon.